Good evening, students. Good evening, Purushottam. Yes. Have you revised what we have done in the last class? Have you done the equalization levy and the transfer pricing introduction, what we have done? Any questions do you have? Is equalization levy very, very clear? I'd asked you to specifically revise equalization levy in detail. Have you done that? I'll just meantime quickly revise the transfer pricing, what we have done so far. In case you have any questions, you can put it in the chat box. So what we have started with is in the transfer pricing is we had understood the reason why transfer pricing was introduced to prevent the base erosion and profit shifting by the which is caused due to the transactions between the multinational companies because of mispricing. Okay. So transfer pricing uses the arm's length principle. That's why the chapter 10 was introduced. Chapter 10, in that the arm's length price is substituted for the transaction price between the multinational companies. Perfect, Purushottam. So that is what is the purpose of the transfer pricing. Then we had seen for the transfer pricing provision to be applicable, there has to be the associated enterprise. There has to be the international transaction. And once both or the specified domestic transaction or deemed international transaction, and if that is there, then only the transfer pricing will become applicable. And then we have to calculate the arm's length pricing, right? So section 92 talks about the applicability of the transfer pricing. It says any income, not only income, but allowance for the expenditure, interest, or any mutual agreement for allocation or apportionment of or contribution to any cost or expense arising from an international transaction shall be computed having regard to the arm's length price. Transfer pricing is not applicable where it results in decrease of total income or increases in the losses. What are the associated enterprise that we have seen under section 92A? So 92A, there's a general definition. If an enterprise which participates directly or indirectly in the management, control, or capital, or if there is one or more person who is participating in both the enterprise in the management, control, or capital. And 92A2, we had seen the deemed days based on the capital-based relationship, control-based, and management-based relationship. Is it clear? So that is what we have covered in the last class. Yes, good evening, Viraj. Purushottam, there's a question on the equalization levy that I'll take it up now only. So if non-resident having no P providing specified services to resident India for business purpose, and equalization levy has been deducted by the payer due to SEP in India, income from specified services as above is subject to tax in India as per 911. Whether that income is taxable on gross basis or net basis after equalization levy? So Purushottam, very good question. But once the equalization levy is applicable, then the transaction gets exempt under section 1050. So therefore, there is no question of then looking into the section 911 significant economic presence. Capital gain rate applicable to non-resident or foreign company at 10% without giving benefit. Is this applicable to unlisted securities of any company or unlisted securities of only closely held? No, any company. Okay, Viraj, please revise the equalization levy too, because that is very, very important and a new topic for you. Okay, so now let's move ahead. We have done the associated enterprise. Now we would be moving towards the next part, which is the international transaction. So we have seen the definition of the associated enterprise, and now we have to look into the international transaction, which is what we have to see now. Now coming towards the international transaction, let's try and understand what is international transaction. So let's write down international transaction. Definition of international transaction. This is given under section 92B. What does it say? International transaction means transaction, international transaction means transaction between two or more associated enterprise, two or more associated enterprise, either or both of whom are non-resident. So, international transaction means what? Transaction between two or more associated enterprise, either or both of whom are non-resident. Now, associated enterprise, we have seen this was defined under section 92A. The associated enterprise we have seen was defined under section 92A. Now, what is here important is that the transaction between two or more non-resident, two or more associated enterprise. Now, out of these associated enterprise, at least one of them should be a non-resident. Now, if I take you back to where we concluded the last class, do you remember what we concluded? That the non-resident having a PE in India or a branch in India, that is included in the definition of enterprise. So the enterprise will include a P. Why? Because the transaction between the non-resident and its P in India is subject to transfer pricing. Whereas I said that Indian companies branch outside India will not be subjected to transfer pricing because the global income of the Indian company is taxable in India, and there are no base erosion profit shifting concerns which are going to arise because any which ways global income is taxable in India. That was the logical outflow. Can you point out one more reason why here transfer pricing is not applicable? Good evening, Geeta. Good evening, Kaushiki. Can you point out one more reason why in this case, because based on just now what I said, from that only you can point out and tell me one more reason why here transfer pricing is not applicable in the second case where there is a branch of the Indian company. Yes, tell me. Yes, Purushottam, very correct. Because here in this particular case, none of the enterprise is non-resident. The branch of the Indian company will also be a resident. Branch of an Indian company is not a separate person, it will be a resident. Now, if it is a resident, therefore, in that situation, for the international transaction, there has to be at least one enterprise which has to be resident. Which has to be non-resident. Here, there is no non-resident entity which is involved. So therefore, TP is not applicable. Are we getting that? So therefore, TP is not applicable. Yes, Geeta, correct. Yes, Mansha, because it is not an international transaction. Yes, Viraj. Okay. So 92B says transaction between two or more A's, one or both of whom are non-resident. Now the term transaction is also defined. The term transaction is also defined under section 92F. The transactions are defined. What does the meaning? What is the meaning of the transaction? Transaction means any agreement, arrangement, or any action in concert, whether in writing or whether or not enforceable by legal proceeding. So that is the meaning of the transaction. Now, transaction in the nature of one second. nature of transaction what is the nature of the transaction which is specified in the 92B? Purchase or sale or lease of tangible property. Similarly, purchase, sale or lease of intangible property. Provision of services. Provision of services. Lending or borrowing of money. Any other transaction having bearing on profits, income, losses, or assets. Any other transaction having bearing on profit, losses, income, or assets. Or mutual agreement or arrangement. Mutual agreement or arrangement between two or more associated enterprise for the allocation of or apportionment of or contribution to any cost or expense. Any cost or expense. Are we clear? So these are the nature of transaction. If you can see, broadly all the transactions are covered. Okay. So this is the definition of international transaction. So international transaction means what? The transaction between the associated enterprise where either of them is a non-resident. Are we clear? Now understand one particular thing. This international transaction, this is one part. There is second part to the international transaction, which is deemed international transaction. Like we had the AE and deemed AE, we have international transaction and deemed international transaction. So this is 92B1 and this is 92B2. Let me make you understand this with the help of an example. Let's say there is a company, or let's say there is Mr. B, which is a kind of, an agent. And let's say there is a non-resident company, C, Inc. And then there is a company, A Limited. Now, A Limited has a subsidiary which is CINC. So CINC is a subsidiary of the A Limited. Let's say wholly owned subsidiary. Now, if A Limited sells the goods to CINC, what will happen? If A Limited will sell the good to CINC, there will be transfer pricing, which will be applicable, right? So in order to avoid that, A Limited did not enter into any transaction with CINC. what it did was, first, Mr. B entered into agreement with CINC. Or let's say, Mr. B entered into agreement with CINC. Agreement on, let's say, 30th May 2022. What was the agreement for? The agreement was for sale of product to be purchased from A Limited. So what did Mr. B did? It also entered into agreement with A for purchasing that product. So sale of product to Mr. B, let's say this is on 1st of June 2022. So Mr. B entered into agreement with CINC that will purchase the product from A Limited. Why this was done? In order to avoid the transfer pricing applicability. Because of this reason, this particular agreement was designed. So, therefore, for this reason, the deemed international transaction has been introduced. The provision on the deemed international transaction has been introduced. What it provides is, where in respect of a transaction, entered into by an enterprise with a person other than A. So this Mr. B is unrelated to A and C both. There exists prior agreement in relation to the relevant transaction between the other person and A, or where the terms of the transaction are determined in substance between such other person and A, and either the enterprise or A or both of them are non-resident. Either the enterprise or the A or both of them are non-resident. Then such transaction entered into between the enterprise and other person shall be deemed to be the international transaction. shall be deemed to be the international transaction entered into between two A's whether or not such other person is non-resident. Is non-resident. So therefore, the transaction between A and Mr. B is deemed to be the international transaction between the associated enterprise, whether or not Mr. B is non-resident. So this will be deemed to be international transaction. Are we clear? This would be deemed to be the international transaction. Any doubt? Did you understand this particular stuff? What is deemed international transaction? Clear? Any doubt? Yes. Is it very clear what is deemed international transaction and what is international transaction? Fine. Yes or no fast? Yes. Perfect, Geeta. So, in order to regulate even these kind of transactions, deemed international transaction was brought into the purview. Are we clear? Okay. Now, once you have known now what is deemed international transaction, what is international transaction, let's try and understand about the specified domestic transaction. About the specified domestic transaction. Now, what is that? What is a specified domestic transaction? So, specified domestic transaction is, let's understand. This is provided under 92BA. Specified domestic transaction. What is this? Now, understand one particular thing. The international transaction, so far as we understand that why this has been brought into the purview of the transfer pricing. But why these specified domestic transactions are brought into the purview of the transfer pricing? Again, let's understand the reason. See, for any anti-avoidance regulation, there is a reason why, or there is a reason as to why they are introduced as the anti-avoidance regulation in first place. Because there might have been some base erosion or profit shifting which was happening, because of which, or there was some tax avoidance strategies which were being used, because of which this anti-abuse regulation is brought into picture. So what is that? Let's try and understand. Let's take an example. Let's say there's a company XY Limited. This is a domestic Indian company, right? It has two units, unit X and unit Y. It has basically two units, unit X and unit Y. Now, unit X, which is there, is claiming the deduction under section 80IA. Unit X, which is there, is claiming the deduction under section 80IA. And unit Y, which is there, is a non-tax holiday undertaking. So unit X is claiming the deduction under section 80IA. Unit Y, which is there, is a non-tax holiday undertaking. Now, let's take for an example, the unit X which is there. Since it is claiming, let's say, the deduction under ATIA. So let's say, for example, if the sales of unit X, let's say it's 100, whereas the sales of unit Y, let's say, is 250. Just assume for an example. Let's say less the expenses, let's say is 50 for unit X and 60 for unit Y. Now what the XY Limited would try to do is, it would try to shift the profits from unit Y to unit X. Because here the profits are taxable, so it would want to shift the profits to unit X, because any which ways there is a deduction which is available under ATIA. So what it will try to do, let's say for example, it will try to make the expenses to unit X and book the profits in unit X. So let's say for example, unit X is making the sales to unit Y, 120 less related party expense 120. So this is moved from here. Sorry, this is moved from here to here. The profits are moved from here to here. Are we getting it? So let's say here my profit comes to 170 and here my profit comes to 70. Here my tax rate is 0%, whereas here it is, let's say, 30%. So I'm moving the profits from here to here. So this is the kind of tax avoidance which this particular provision is trying to target. The specified domestic transaction is trying to cover this profit shifting which is happening from non-tax holiday undertaking to the tax holiday undertaking. Are we clear? So that is the reason why this particular transaction is there. So what is specified domestic transaction? Let's try and understand. It is defined under section 92BA. Section 92BA provides the meaning of the specified domestic transaction, which means any transaction, or one second, let me put it more easier for you. Specified domestic transaction, let's put it in two parts or three parts basically. Undertaking claiming profit linked deduction. Undertakings claiming the profit linked deduction. So the inter-unit transfer of goods and services. Inter-unit transfer of goods or services by an undertaking or unit of an enterprise or eligible business to other business carried on by the assessee for consideration which is not corresponding to the market value on the date of transfer. For consideration not corresponding to market value. This is already covered under section 80A. Covered under section 80A. Second, transfer of goods or services under ATIA 8. inter-unit transfer of goods or services, inter-unit transfer of goods or services between eligible business and the other business. Between the eligible business and other business where the consideration for the transfer does not correspond with the market value. Where consideration for the transfer does not correspond to the market value. This is under section 80IA 8. Under section 80IA 8. Third is any business transacted between the assessee carrying on eligible business and any other person as referred to 80IA 10. So transaction between entities having close connection. Transaction between entities having the close connection. Section 80 IA 10. Next is any transaction under chapter 6A or 10AA or section 10AA to which provisions of 80IA 8 or 80IA 10 are applicable. Section 80IA 8 or 10 are applicable. Are we clear? So that is chapter 6A, 35AD, 10AA, right? Second is, the second limb over here is here also we have under the specified domestic transaction one more provision which is there. The business transacted between a company, which is opting for 115 BAB. 115 BAB. What is 115 BAB? What is the tax rate under 115 BAB? Yes, fast. What is the tax rate under 115 BAB? I want to know it from you. Yes. 115 BAB. Business transacted between the company opting for 115 BAB and company and other person with which it has close connection. Yes. What is the tax rate under 115 BAB? Fast. It is 15%. Yes, Geeta, correct. So 15% is the tax rate. Yes, Mansha. Kaushiki, yes, 15%, correct. So if let's say I'm trying to shift the profits from 30% to 15%, that is also covered in the specified domestic transaction. Now, all these transactions are covered within the purview of Section 92BA. But these transactions will not be treated as specified domestic transaction in case the aggregate of such transaction does not exceed the sum of rupees 20 crores. So this will be treated as SDT only when the aggregate transaction value exceeds rupees 20 crore. Exceeds rupees 20 crore. And in this particular case, if once it is treated as specified domestic transaction, then the arm's length principle, the determination of arm's length, all of that, as it is applicable for international transactions, similarly, it will be applicable for the specified domestic transaction. So everything else then will remain the same. Also, under section 92, the applicability of transfer pricing. When we were talking about the applicability of transfer pricing here, we had just mentioned here about the international transaction. Nowhere I had mentioned about the SDT. So how come I'm in between talking about the SDT? For covering the transactions within SDT, first of all, section 92 should include the SDT. So whether it includes that, the answer is yes. Section 92 2A provides that the income which is arising, or provides that any allowance for an expenditure or interest or the income or allocation of any cost, income, expenditure, interest or allocation of cost under the mutual agreement in relation to a specified domestic transaction. In relation to a specified domestic transaction shall be computed having regard to the arm's length price. Shall be computed having regard to the arm's length price. However, the provisions of specified domestic transaction will not be applicable if it results in decrease in total income or increase in losses. Same provision will apply over here also. Are we clear? Yes, Purushottam, if it is more than 3 crores, but how can it be more than 3 crores below 20 crores? If it is, okay, you are saying about the GAR applicability. If it's more than 3 crores, yes, then the GAR is applicable. Yes. And if it is less than 20 crore, then any which ways you have the provision under 80IA 8, 80IA 10 and 80A also, which substitutes the market value and not the arm's length price. So if SDT is applicable, then there will be the substitution of ALP to the transaction price. If it's not SDT, even under 80IA 8, 80IA 10, 80A, the AO can substitute the market value. There is a difference between the market value and the arm's length price. Arm's length price is computed with the methods. Kaushiki, in international transaction, if both associated enterprise are non-resident, then why India needs to apply TP? One of the non-resident could have a PE in India. Then in that particular case, that PE may be transacting with the other non-resident. So therefore, there is a need of applicability of TP. Are you getting that? Okay. Okay, so let's move further then. Let's move further. Then we are moving towards the next part, which is the computation of the arm's length price. computation of arm's length price. As per section 92, what does it say? That the income from the international transaction shall be computed having regard to arm's length price. Now, what is arm's length price? Section 92F 2 talks about the arm's length price or defines the arm's length price. It provides that a price which is applied or proposed to be applied in a transaction between person other than A in uncontrolled conditions. In uncontrolled conditions, a price which is applied or proposed to be applied in a transaction in person between person other than the A in uncontrolled conditions. So what is ALP? ALP is the price between the independent enterprise. What the independent enterprises would have charged in similar circumstances. That is my arm's length price. Now you will say, ma'am, arm's length price is more or less the market price only. No. Arm's length price has to be computed as per the methods which are provided under section 92C. So arm's length price means a price which is applied between the person who are not A's in uncontrolled condition. Now section 92C provides the methods for determining the arm's length price. Provides the methods. Now what are the methods? There are two methods. There are 5 methods, but we'll categorize into 2 segments. The direct or the traditional methods, and the second one is transactional methods. Under the direct method, we have comparable uncontrolled price, cup method. Second is resale price method, RPM. Third is cost plus method, CPM. Under the transaction method, we have 2. Transaction net margin method, TNMM, and profit split method, PSM. So these are the methods of the transfer pricing. Now first we'll start with the cup method. First we'll start with the cup method. Now, the comparable uncontrolled price method. Let me give you an example first to understand this, and then we'll talk about this, and then you will solve the question. So first we'll understand through an example, and then I'm going to give you the question for you to solve that. It's pure kind of logic and mathematics. Here you do not have to apply any legal provision in transfer pricing. All this while you were trying to interpret the tax law. In the transfer pricing, you don't have to interpret any tax law. Transfer pricing is very simple in terms of you have to understand the business, you have to understand the transactions, you have to understand the agreements, and calculate the pricing. So you should be only good with business facts and the transaction. That's it. Here you do not have the legal interpretation. Oh, we have to interpret it like this, like that. No, nothing like that over here. So let's take an example. Let's say, for example, there is A Limited, which is there. Now, it has, let's say, a subsidiary, which is, let's say, AINC. A Limited has a subsidiary, which is AINC. Now, this is non-resident, let's say, a US company. Now, A Limited, let's say, it supplies maybe, let's say, some industrial material or industrial equipment. Let's say it supplies 50,000 units at the rate rupees 3,000 per unit. Now, this is the transaction price. Now, both of these are A. This is a supply of goods, which is an international transaction. So, transfer pricing is applicable. Let's say A Limited sells these goods to the unrelated party. Let's say XINC. Let's say it supplies 15,000 units to the XINC at the rate of, let's say, rupees 4,000 per unit. So, let's say it is supplying the 15,000 units at the rate of 4,000 per unit. Now, if you see, here I'm supplying at 3,000. Here I'm supplying at 4,000. So, I will take this as my arm's length price. I will take this as my arm's length price. So this is what the cup method says. Identify the price charged for similar goods or services provided in comparable uncontrolled transaction. This is what the cup method says. It's a very direct method. You directly compare 3,000 with 4,000. This kind of cup is known as internal cup. Meaning, my company itself is supplying to unrelated parties. So, internally itself, I have a comparable uncontrolled price available. So, this is called as internal cup. There may be an external cup as well. What is an external cup? Let's say, for example, if I did not have this internal transaction available, I'm only making the sales to related party. I do not make sale to unrelated party. So what I will do is, I will identify whether there are any enterprise which are engaged in the similar business as mine. Let's say I find out that there is X Limited which is engaged in the similar business of selling the industrial equipments. And it is making the sales, let's say, to other parties, let's say at rupees 4,000 per unit. So this will be my external cup. Most of the time, practically, the external cups are not available unless it's the price of the shares for which, quoted shares for which the share prices are available on the stock market. There are some list prices which are published for certain goods. Unless that is the case, in very few cases, the external cup is available. Most of the time, it is internal cup which is used. Because that is more reliable data what you're getting and easily available data what you're getting. So this is known as the internal cup and external cup. So it's a direct price comparison you make with the unrelated price. What does it say? Identify the price charged for similar goods or services provided in comparable uncontrolled transaction. Price for the similar goods. Whether you will compare the price, let's say, of bicycle to a motorcycle. Let's say I have the bicycle and I have the internal cup of motorcycle. I'm selling bicycles only to my related party. I'm selling motorcycles to the unrelated party. Will you compare that? Yes, Geeta, in all international transactions, you have to apply the 3P provision. Purushottam, the TP will override 80 IA, 80 IA 10, 80A if it exceeds 20 crore, not the other way around. Yes, what I was asking you, will you compare the price of the bicycles with the price of motorcycle? No, you cannot compare. Why you cannot compare? Because these are not similar goods or services. You cannot compare apples with oranges. Can you compare the price of the laptops with the desktops? Purushottam, I'll come on to the uncontrollable price. Yes, Mansha. Can you compare the price of laptops with the desktops? We can, at least, because those are similar goods, isn't it? So similar means what? That at least both of them should have the same utility. Are we getting that? So that is the meaning of similar goods or services. Now, provided in a comparable uncontrolled transaction. You understand what is comparable? Comparable means what? That both of the transactions are similar to the extent, listen to this very carefully. Both of these transactions are similar to the extent that there are no material differences between the transaction which would have impact on the pricing. There should not be the material impact on the transaction which impacts the pricing of the product. No material impact on the transaction. Sorry, no material differences, not impact. No material differences in the transaction which could impact pricing of goods. What do I understand by this? No material difference in the transaction. Let's take an example in this case itself. Let's say the A Limited gives a volume discount. To AINC, which it does not give to XINC. Or A Limited provides some warranties to the AINC which it does not provide to the XINC. Or let's say, for an example, if the A Limited sells the goods to AINC on CIF basis, cost, insurance and freight, whereas these goods, let's say, are sold on FOB basis, freight on board. Or let's say, for an example, there is some discounts which are there, which is what I've written. In these cases, if there is any discount, if there are any warranty, there are any insurance charges or CIF, the transactions are not comparable. Why? Because there are additional factors which are impacting the pricing. If I am giving volume discount, it is very obvious that the price of A INC would be lesser as compared to X INC because there's a bulk purchase which is happening. If the A Limited is selling on CIF, obviously there is insurance and freight which is there, which is not there in the case when it is sold to X INC. So all these factors are going to have impact on the transaction and therefore it makes them non-comparable. So now you will say, oh ma'am, then we will not be able to use the cup method. No, that's not the case. You will have to make the adjustments for this. So you have to make the adjustment, adjust the price for quantity discount, warranty charges, insurance, freight. So for this, you will have to adjust the price. In case there are any differences where you are not able to adjust the price, then you may not be able to use the cup method. If there are only the differences which are having the impact on price, let's say there are insignificant differences which are not having any impact on pricing. Let's say XINC is located in some different region and there may be, little pricing difference because of that, which is a minor difference, or which may not be even having any pricing difference because it is located in, let's say, Mumbai, it is selling in Mumbai and this A Limited is selling in, let's say, Chennai. It is not having any impact on pricing. So then that difference need not be adjusted. But let's say, for example, if because of the geographies to different regions, you are not able to adjust the pricing difference and there is an impact on pricing, then you will not be able to use cup method. Cup is a very sensitive method. Because you are making the direct comparison of the price, the product should be very similar and it should be a comparable transaction. What do we mean by uncontrolled? Uncontrolled means it's not controlled by the factors which are there between the A. It is not being controlled by the A's. So uncontrolled transaction. Are we clear? Yes or no? Yes, Kaushiki, we can use any internal or external cup. Fine. Okay. So will you solve one question on this? From your module itself, there's a question. Let me share the screen of module. Let me increase the size. Yes. US Limited, a US company, has a subsidiary IND Limited in India. US Limited sells the computer monitors to IND Limited for resale in India. US Limited also sells computer monitor to CMI, the another computer reseller. It sells 50,000 computer monitors to IND at 11,000 per unit. The price fixed for CMI is 10,000 per unit. Warranty in case of sale of monitors is handled by IND. However, for sale of monitors by CMI, US is responsible for the warranty for 3 months. Both US and IND offer extended warranty at a standard rate of 1,000 per annum. On these facts, how is the assessment of IND going to be affected? Yes. Please solve the question. No, Kaushiki, that's not the correct answer. No. How did you get 7,000? Yes, give me the answers fast. No, Geeta, that's not the correct answer. Okay, let's try and understand. US Limited, a US company, has a subsidiary IND Limited. Now, both of these are associated enterprise since US Limited is the holding company of Indian Limited. US Limited is selling the computer monitors to IND. So this is something which is an international transaction. So therefore, transfer pricing will be applicable. Now, US is also selling the computer monitors to CMI, another computer reseller. So it is selling the identical computer monitor to independent enterprise. So therefore, the price charged by US for a similar product transferred in a comparable uncontrolled transaction is identifiable, and therefore we can use the cup method. So how in exam you are going to first write, you are not going to straight away jump to solving the question. First, you will write whether the entities are A, whether the transaction is international transaction, and why you are selecting a particular method. So write it in a point-wise format. Whether the entities are A, whether it is an international transaction. Third point, yes, transfer pricing is applicable. Fourth, why your selection of a particular, or you will write like this in exam, you will write like this. Let me give you a format. So first, associated enterprise. Second, international transaction. Third, TP applicable. Fourth, you will write selection of, use this word, most appropriate method. Selection of most appropriate method. Why you are selecting a particular method, you have to write here. Since here we have the comparable uncontrolled transaction, and because of which we are using that particular method, that's what we will write over here. Fine. So this is something which is there. Now cup method you can use. Now what you will do is, for the cup method, first thing, if you see, it says that the price fixed for CMI is 10,000 per unit. So sale price charged by US to CMI is 10,000. But here you will write a point that in the cup method, the price needs to be adjusted for any differences between the international transaction and uncontrolled transaction. So you have to make the adjustment. Here you have the warranty which is there in case of sale of monitors, but Ind Limited is handled by Ind only. However, for the sale of monitors by CMI, US is responsible for the warranty. So US is giving the warranty, US is bearing the cost of the warranty for 3 months for the CMI, which it is not bearing for Ind. So obviously there is going to be a pricing difference between the price of the Ind as well versus the price of the CMI. So that needs to be adjusted. Now the warranty is given 1,000 per annum. 1,000 per annum is given, and the warranty is given for how many months? For 3 months. So from the 10,000, you will reduce the warranty charges, which is 1,000 into 3 divided by 12. You can look at the answer here, which is 250. So what is my arm's length price? 9,750. What is the actual price paid by into US? 11,000. So 1250 for 50,000 units, which comes to 6.25 crores. This will be my addition to my income. This will be considered as addition to my income. Are we getting that? Are we clear? Yes or no? So did you understand how do we have to calculate the cup method? Yes, you have to read the question very carefully, Kaushiki. If it would have been, let's say, insurance and freight charges, then you would reduce that as well. So, if let's say, for example, there is an Indian company which is supplying the raw material, let's say, to the US company. Now, let's say, for example, the Indian company is supplying the raw material on CIF basis, whereas it is supplying to the unrelated party for freight on board basis. So what you will do is, from the freight on board, if your price is based on freight on board, let's say to your holding company you are providing on freight on board, and let's say you are selling the goods on CIF to unrelated parties. So from CIF you will reduce the insurance and freight charges. Clear? So this is how the adjustment needs to be made. Similarly, if there is quantity discount, you will make that as an adjustment. Are we clear? Okay. Next one. Resale price method. Now, before we go on to resale price method, understand in the cup method, you are comparing the price. In the cup method, you are comparing the price. In the resale price method, you compare your gross profit divided by sales. What is my gross profit? Gross profit is my sale minus purchases minus direct expense. Here I am comparing either my sale or my purchase price. Here I am comparing sale minus purchase minus direct expense, which gives me my gross profit. So here I am comparing the gross profit margin. Here I am comparing the gross profit margin to the sales. In the cost plus method, I compare gross profit to the cost. I compare the gross profit to the cost. Whereas in the TNMM method, I compare net profit to the cost or sales. Net profit is what? Sales minus purchase minus my operating expense. Sales minus purchase minus operating expense. So this is the difference between all the methods if I have to summarize. Cup, you compare the price. RPM, you compare the gross profit upon sales. CPM, you compare the gross profit upon cost. TNMM, you compare net profit upon the cost or sales. Now first, let's talk about the RPM. Now, as the name suggests, which is the resale price method, this method which is there is used for resale of goods or services. Now let's take an example. Let's say there is A Limited. Or let's say there is A Inc. and it has a subsidiary A Limited. Now let's say this A Limited, which is there, is importing goods from A Inc. at, let's say, rupees 1200. It is importing the goods from A Inc. at the rate rupees 1200. And let's say it is reselling the goods without any modifications. It's a direct resale. There are no modifications. If there is modification, this resale price method is not applicable. So let's say it is reselling at rupees 1350. It is reselling at rupees 1350. And let's take an example. There is unrelated party which is there, which imports, let's say, PQR Inc. and there is, let's say PQR Limited is importing from any person, not PQR Inc. necessarily. It imports similar goods at, let's say, rupees 1150. It imports the similar goods at 1150 and makes the sale at, let's say, resell at rupees 1400. Right? So what you will do is, first you will identify the gross margin over here. What is my gross margin over here? It is 250 divided by 1400 into 100. What is my gross margin percentage? Let's say it's 18%. Now, this is the arm's length gross margin. This is my arm's length gross margin. Now I will apply this particular margin to this transaction. Now in this transaction, which one is a controlled transaction? This is a controlled transaction. Why? Because this is the transaction between two A's which is influenced by A. This I am making resell to a third party. So this is uncontrolled. So I need to identify the ALP for which particular portion? I need to identify the ALP for this. I need to arrive at this particular price. What is the ALP for importing of goods? So I'll start with this one. So I'll start with sale price, which is, let's say, rupees 1350, less arm's length gross margin, which is how much? Let's say 18% I will apply. And I will get the arm's length purchase price. I will get the arm's length purchase price. So 1350 minus 18%, what it comes to, let me calculate. 1350 minus 18%, 1107. And I have imported at 1200. So 1107 minus 1200, 93 rupees will be the TP addition. Fine. Here also you will make the adjustment for the differences in the pricing. Are we clear? Yes or no? Any questions? Is resale price method clear? Why do not we taking the difference and add back to the warranty portion for 3 months? Is this also correct? No, Purushottam. You will have to start with the unrelated or uncontrolled price. And you have to arrive at what is the ALP. You cannot start from the controlled price because that is controlled. Clear, Purushottam? Okay. Now let's take a question on the resale price method from your module again. So illustration 2, Earth Limited Calcutta is engaged in trading of electronic goods. It purchased the goods from its AE, Sun PE Limited Singapore, and also from unrelated party Oceania Limited UK. For the financial year 21-22, the gross profit margin was 15% on the sale of goods of Sun PE Limited, whereas it was 20% in case of Oceania. After sales warranty provided for 6 months was provided by Sun PTE, whereas Oceania Limited gave the after sales service warranty of 1 year. The cost of the warranty may be taken as 2% of the sales price. The Sun PTE Limited's brand value is internationally known, and the benefit of the brand value can be taken as 1% of the sale price. During the financial year 21-22, it sold the goods of Sun PT for 20 crores and of Oceania for 15 crores. As regards transport cost of the goods purchased, there was no difference between the related and unrelated party. Compute the ALP of the transaction between Earth and Sun PT Singapore by applying the resale price method considering the facts of the case. Yes. No, Kaushiki. Yes, Jacob, very good. That's the right answer. How did you calculate, Jacob? No, Kaushiki, that's not the correct approach. Okay, we'll look into it, how we have to do it. Okay, let me show you how we have to do. First, you will start with whether these are associated enterprises or not. So, if you see Earth Limited, which is there, is engaged in trading of electronic good, it purchased from its AE. It's already mentioned that Sun PT is its AE. The transaction for purchase of electronic good is an international transaction, therefore TP will be applicable. In this case, most appropriate method is already given in the question that you have to apply the resale price method. Fine. Now, if you see here, what is it mentioned? The gross profit margin was 15% of Sun PT. In this case, the gross profit margin is already given. And it was 20% in case of Oceania. So I will have to start with the 20%. I will not start with 15% because 15% is a controlled transaction. 15% is on the controlled transaction. 20% is on uncontrolled transaction. So I'll start with 20%. After sales warranty of 6 months was provided by Sun PT, whereas Oceania has given the warranty of 1 year. So obviously Oceania has given more warranty as compared to Sun PT. So we need to make an adjustment for that. The cost of the warranty may be taken as 2% of sales price. Now, those of you who have adjusted directly 2%, that is wrong. Because 2% is of the sale price. No, Kaushiki. Jacob, your answer is correct, but your numbers are correct. Your entire answer is not correct. So your only number figure is correct. That's why I asked you that how do you arrive at 16 lakhs? So 16 lakh is the correct answer, but the calculation that you have shown is not correct. So it's, blessing in disguise that you're getting the correct answer, but that's not the way you have to solve. Okay. So here, if you see, the after sales warranty will not be adjusted directly on the gross margin of 15% because gross margin is 15% on sale of goods, whereas the cost of warranty is 2% of the sale price. We are not given the sale price. We are given the sale price at the end. Okay. So what you will do is you will take first the sale price, the resale price, which is there. So it has sold the goods of Sun PT for 20 CR. So 20 CR is a resale to the third party. I will start with that. I'll start with 20 crores. 20 crores is the resale to third party, which is uncontrolled. So I'll start with that. So if you can see, 20 crore is the resale price. Less profit margin of, with reference to the uncontrolled transaction between Earth and Oceania. I will apply 20% and not 15% because 20% is the arm's length resale price margin, which is coming to 4 lakh. Now here I will make the adjustment for the cost of warranty. In the 20%, there is the warranty charges for 1 year. Whereas Sun PT has the warranty charge for only 6 months. So if you see over here, What it says, after sales warranty of 6 months was provided by Sun PT, whereas Oceania has given the sales warranty of 1 year. So there is additional 6 months warranty which is given to the Oceania, which is not given to the Sun PT. So for the 6 months, I will make the adjustment. For the 6 months warranty, I will make the adjustment, which is 2% of the sale price. So 2% of 20 lakh into 6 divided by 12. So there is a gap of 6 months. That I will reduce it from the gross profit to make it comparable. Because to Oceania, you are giving 1 year warranty. To Sun, you are giving 6 months. So I will reduce additional 6 months to arrive at the arm's length price. Next is for the brand value. The Sun PT's brand value is internationally known, and the benefit of the brand value can be taken as 1% of sales price. It sold the goods of Sun PT for 20 CR. So 1% of 20 CR is the brand value of Sun PT, which is not there in case of Oceania. So I will add it back because that is not present in the case of Oceania. So adjustment of the brand value, 1% of sale price. So plus 20 minus 20, the answer remains 16 crore. So that's how you got Jacob 16 crore, but you got only this much. You have not made the adjustments of these two. Are we clear? Is this particular question clear? Yes or no? Is this question clear? Yes, any questions? Did you understand this? Yes or no? 2% is per annum, Kaushiki, and you have to apply for 6 months because there's a difference of 6 months. No, we don't take 15 CR. Jacob, we will not take 15 CR. Because here the sale price of Sun PT, the resale price is already uncontrolled. So why you take 15 crores? The gross profit margin is already given to you. If it would not have been given, then you would have started with 15 and found out the gross profit margin. Geeta, it's like, more like costing only. You have to think about it as to what adjustments you will make. And with practice, you will understand it. Okay? Okay, let's take a break of 10 minutes and then we get back. So there are some questions which I can see. Purushottam, brand value, explain it again. So if you see that this Sun PT has a brand value, which Oceania does not have it. So for that purpose, we are kind of adjusting for the brand value. So if we have the brand value which is already there for Sun PT, I would add it in the in terms of the this thing for the Oceania, because I have to arrive at the arm's length price. So for the this thing, for the Sun PT price, the brand value was considered, but it is not there for Oceania. So therefore, I'm adding it in the price which I have given. So there is a resale price which we have started with, which is from the Sun PT, less the profit margin, which is 20%. Now, if you see this 16 lakh, which is there, this is the purchase price. This should have been the purchase price, right? Now I'm making the adjustments to that. So because of the brand value, what will happen is, because of the brand value, my pricing would be obviously different from what Oceania was charging it. So therefore, I'm carrying out the adjustment for the benefit of the brand value of Sun PT. Obviously, when there's a brand value, the pricing is going to be higher. So I'm adding it, the brand value charge, which is there. Secondly, cost of warranty, which is there. Now, as well as the warranty, you are saying that we have started with 20 lakh, and therefore you are saying that the 6 months which is there is already considered. So, Purushottam, we are saying in case of warranty, more warranty is provided by unrelated party, which means it has charged more than our A. Here, we have not considered the gross profit. We have considered the gross profit percentage. And we are starting with the price of the uncontrolled transaction with the third party. We are not charging with the price of the controllable price with A. We are not starting with that. So if you see, I have to make it a comparable price. So for related party, I am providing 6 months warranty. To unrelated party, I am providing 1 year warranty. So therefore, ideally, the warranty should have been for 1 year period, isn't it? And therefore, I'm making the adjustment for that 6 months additional, which is there, that I am reducing. If I would have the warranty for additional 6 months, what the unrelated party has provided, instead of the related party, what would have been my pricing? So that I am reducing it. Clear, Purushottam? Which means I will have to calculate, like AE says, if I am also providing 1 year warranty, yes, I'm charged more. That why I'm adding, what is it? Yes, it will be added. Yes. So here your warranty will be reduced and not added, and brand charges will be added, because then if I'm giving the 6 months warranty to the related, I'm getting 6 months warranty from the related and 1 year from unrelated, then what would have been my pricing? So see, in this particular case, if you notice that the warranty which is given is not by Earth. The warranty is from the Sun PT Singapore or from the Oceania Limited. Now, Oceania is giving me the 1 year warranty. Sun is giving me the 6 months warranty. Are you getting that? So, because of the high warranty charge, I am not giving it. It is not my expenditure. They are giving me. So, therefore, what would have happened? My price or the 20% gross margin which is there would have been on a higher side. So, I'm reducing it to 6 months so that I align it with the Sun PT. So my sale margin which is there, the margin on the sale which is there would have been higher, because the higher period of warranty is given. Let's say if you're buying a product, electronic product, if you are given a 1 year warranty, your price goes high. They embed in the price itself, right? If you're given the 6 months warranty, your price will be little lower. So I am coming from 1 to 6 year or 6 months, 1 year to 6 months. So that is why I'm reducing for the 6 months. I'm reducing the purchase price because of that. It is not that it would have been already considered in 20%. It is already considered in 20%, but what I'm trying to do, I'm trying to come from 1 year to 6 month price. So 1 year would have the higher price which is included, and therefore I'm reducing it. Clear? Any other question? Any other doubt? Yes. Okay. Let's move further then towards the cost plus method. Now this method which is there, as I told you, this is the gross profit to the cost. This is gross profit to the cost. Now, how do we understand this method? See, resale price method, as it was name suggesting, it is the resale price or on the resale distributors or on the resellers or distributors. Cost plus method, when is it used? So understand, let's say for example, there is AINC, a US company, which is a service provider. Let's say it provides the services of selling the computer software or development of software. Nowadays, if you have seen, India has a big back office operations. Most of the US company, European companies are outsourcing their back office operations in India. Isn't it? You have seen so many back office operations of the US company doing the accounting work, doing the back office, this business process outsourcing work, BPO, which is there. They are doing the human resource management over here. So many back office operations, software development is happening over here, whereas the sale of the software is by the US company. So India has become a big hub of back office operations. Right? So in this particular case, let's say, for example, this AINC has a subsidiary A Limited. This is a back office operation, BPO. Now, A Limited provides these services to US company. So, in the P&L account of A Limited, there will be the services to US company. This will be my controlled transaction for which I need to find the ALP. Isn't it? In the case of resale price method, this is a reseller P&L. Here, the sales which is there is to the unrelated party. The purchase which is there is from related party. So this was my control transaction for which I had to identify my ALP. So what I was doing is I was calculating the profit on sales because I had to arrive at this figure. So I was doing sales minus gross profit to arrive at ALP. Here, I have to arrive at this figure. I have to arrive at this figure. I have some cost, which may be, let's say, salary, office, rent, whatever. Now, these are to the third party. So this is uncontrolled, right? This is uncontrolled. I have the profit. So what I'll do is I will add profit to the cost. So cost plus profit will give me ALP. So if I take you back, to where we started. Here my price is the ALP. Here my sales minus gross profit will give me the ALP. Here my cost plus gross profit will give the ALP. So the CPM which is there is used mostly for the service providers. CPM is used for the service provider where the markup on the cost is calculated. Are we clear? So let's take an example. Let's say there is A Limited providing support services to A INC, US company. Are we clear? Let's say, for example, here in the same case, or let's take a similar case, A Limited also provides the services to say XY Limited, which is unrelated. Now, let's say here it provides the services at, let's say, 25 per hour. And here it provides services, let's say, 36 per hour. Right? Now, in this case, here the difference between the two will be here what I will do is, here I am providing the services at 36 per hour. What is my cost which is there? Let's say my total direct and indirect cost are 15 per hour. So what will be my profit in this particular case? 36 minus 15. This will be my profit. So gross profit is equal to 36 minus 15 divided by 15 and not 36, because here we are calculating on cost. And this 36 minus 15, what does it come to? Divided by 15 into 100. I think there's some mistake. 140%. Yes. Isn't it? So now what I will do is I will apply it on this cost. So 15 plus 140% will give me my ALP. So what does it come to? 36. And I'm charging only 25. So 36 per hour is the ALP, whereas I'm charging 25. So I will have to make addition for this. Are we getting that? Yes or no? Yes or no? Is cost plus method clear? Yes or no? Purushottam, yes. So the price charged by the AE includes 6 months warranty and not the 1 year warranty in the past question if you see. The Sun PTE, which is there, is providing 6 months warranty, whereas Oceania is giving 1 year warranty. So therefore, I am reducing it, that additional 6 months warranty which the Oceania is giving. So your price has included only 1 year warranty and not the 6 months warranty. The 20% markup which is there has the 1 year warranty and not 6 months, because 20% is coming from Oceania. So I should reduce it in order to arrive at the cost of the Sun PTE. Are you getting that, Purushottam? If you read the question correctly, you will understand. So that is why I am reducing it. Clear? Ready? What is your question? I have not received any of your question earlier. Okay, I saw it. If both associated enterprises are non-resident, how can an enterprise be taxed? They can be taxed as the non-resident company is taxed. Yes, Purushottam, I'll explain the CPM again. Did you understand the RPM question, Purushottam? Is RPM question clear to everybody? In case you have not understood, please let me know. Yes. Okay. So under CPM, I'll explain it again. Here, if you see, AINC is providing, A Limited is providing the services to AINC. Now, the services are, let's say, provided for 25 per hour. A Limited is also providing the similar services to XY Limited for 36 per hour. So 36 per hour, which is there, and my cost is 15 per hour. So 36 minus 15 divided by 15. Because here I have to take it on the cost and not on sales. Why? Because here what I'm trying to find out is the sales figure. So here I have to take the profit. When I will add the profit to the cost only, then I will get the ALP sales, right? So therefore I have to calculate the GP on cost. So 36 minus 15 divided by 15, which is 140%. I will apply this 140% on the cost. Cost is same for both. A Limited providing services to XY also as well as to AINC. Cost remains same. So 15 plus 140% will give me the ALP 36 per hour. So the ALP is 36 per hour for the US company, and I'm charging 25 per hour. So therefore, there is a difference in the transaction price and the ALP, and therefore I need to make the adjustment. Clear? For transfer pricing purpose, in the same way, ready as you do it for one resident to another non-resident. Is it clear? Yes or no? CPM, RPM, both methods clear. RPM, last question clear. Will you solve one question on CPM? That will clarify it further. Will you solve one more question? Yes? Okay, let me give you the question then on CPM. In case you are still not able to understand, ask me 10 times. I do not have problem, but be clear with the question. There is no harm in asking 10 times. It doesn't irritate me at all. So please ask. Nano INC, a German company, holds 45% of equity, 45% of equity in Beta Limited, an Indian company. Beta Limited is engaged in development of software and maintenance of same for customers across the globe. During the financial year 22-23, Beta Limited had spent 2,400 man-hours for developing and maintaining software for Nano INC, with each hour being billed at rupees 1,300. Cost incurred by Beta for executing the work for Nano amounts to rupees 20 lakhs. Beta Limited had also undertaken developing software for Yama Limited, for which it had billed at rupees 2,700 per man-hour. Beta Limited made gross profit of 60% on Yama Limited work. The work performed for Yama Limited and Mano Inc. is comparable, subject to following differences. Nano Inc. gives technical know-how, support to Beta, which can be valued at 8% of normal gross profit. Yama does not provide any such support. Since work for Nano involves huge number of man-hours, a discount of 14% of normal gross profit was given. Beta had offered 90 days credit to Nano, cost of which is 2% of normal billing rate or normal gross profit. Let's say normal billing rate. No such credit is given to Yama. Calculate the ALP. Yes, you will find out the gross profit of beta. That's correct, Jacob. No, manners of Yama is not missing, Jacob. It's on cost. 60% on cost, Koshiki. Yes, I know this is little trickier sum. That's why I'm giving you a little more time. Okay, let's solve together. I know this is little trickier. So let's solve it together. I'll tell you how to you proceed with this. Okay, fine. See, first, in this particular case, here the gross profit of Yama is given. Gross profit of 60% on work of Yama is given, which is the ALP margin, right? So I'll start with the gross profit marker in case of Yama. 60%. I'll start with that. And then I'll make the adjustment because here the adjustments are to the gross profit only, if you see, right? Nano INC is giving the technical know-how support to beta, which can be valued at 8% of the normal gross profit. So Nano is giving me the technical support and therefore I have to reduce my gross profit markup, which Yama is not giving. So less value of technical know-how. 8% of 60%, 4.8. Since work for nano involved huge number of man hours, a discount of 14% was given. So I will also reduce that discount here, quantity discount, which is 14% of normal profit, which is 60%. 8.4, right? Beta has offered the 90 days credit to Nano, the cost of which is 2% of normal billing rate. No such credit is given to Yama. Now, this credit is given only to Beta and not to Yama. Isn't it? For the credit also, I will have to make the adjustment. So what I'll do is add cost of credit, which is 2% of normal billing rate. Let's assume the normal billing rate is 100%, because here we are talking all in percentage terms. So the billing is obviously 100 and the markup is 60. So that gives me 2%. So all of this will come to how much? Arm's length gross profit markup is 48.8%. Are we clear? So first we have made the adjustment for the technical know-how support, which Nano is giving to Beta. So I'm reducing that, which is not there in the case of Yama. Secondly, the quantity discount is not there. So I'm reducing that as well. Right? And there is a credit period cost, which I am adding it. So this is, I'm reducing it from the profit margin. So I'm getting my basically gross profit. I'm adding the cost of credit to it because this is given to the Beta and not to, this is given to Nano, but I'm not given to Yama. Are we clear? So I'm adding the cost of credit. So this gives to 48.8%. Now what I'll do is this 48.8%, which is there. Here, what I'll do is I need to identify the cost incurred by Beta for executing Nano INC work. So let's say 100 is my sale price, 48.8 is the profit margin, 51.2% is the cost, right? So 51.2% will be the cost. Now what I'll do is, here if you see, what is it given? Cost is given as 20 lakhs. Cost is already given as 20 lakh. The cost for executing the work is 20 lakh. So this is my 51.2%. So then what will be my profit? My profit will be 20 lakh into 48.8 divided by 51.2. Because 20 lakh is 51.2. So then what is 48.8%? So it is 1906,250. My arm's length price will be 3906,250. And less transaction price, how much I have charged? My transaction price is 1300 into 2400 man hours, which comes to 31,20,000. So addition will be made of 7,86,250. Clear? Yes or no? Yes or no? Where you are stuck up, Jacob? Yes. Any questions? Did you understand? What is the problem in Kaushiki? Why less as in for what you are saying? Why credit was added? Jacob, the credit which is there is given to the nano, which is not given to the what was the name? Yama. So therefore, the cost of the credit I will add to the cost. Right? So the cost of the credit which is there, I will add that to the cost. So this 46.8 which is there, this is my GP. I'm adding the 2% which is on the normal billing, the cost, and I'm increasing the GP because of that. Isn't it? Why will I reduce the GP? My GP which is there will get increased with the cost which is there, because there I'm calculating on cost. Clear? Any other question? Did you get Jacob? So I'm starting with the 60%, which is gross profit. I'm adding the reducing the differences. That gives me 46.8%, right? On that, I will add the cost of the credit. That is a cost which is there. So that I will have to add it over here. Cost for the credit, which is incurred by the beta. Yes, that's true. So beta has offered a 90-day credit to the nano, the cost of which is 2% of the normal billing rate. Clear? A credit period is given. Yes, any doubt, any questions? Is it clear? Okay. Now we move on to the one more question on the cost plus method from your module. One more question. Shall we solve? Okay, let me give you one more question myself only so that you are clear about this. Yes, just write down. Give me a minute. Yes. Let's write. Anant Limited is engaged in providing IT-enabled services, ITES. It is subsidiary of AB Inc. in US. It also provides similar services to PQR Limited. Its billing and other information is as under. Billing per month to AB Inc. USD 85,000. Billing per month to PQR USD 70,000. AB Inc. has provided loan of USD 1 lakh to Anand. Towards purchase of software for executing its project. Rate of interest is 3% per annum. Direct and indirect cost incurred are USD 100 and USD 200 per hour. Anant Limited works 9 hours per day for 15 days to execute the projects for ABINC, and 8 hours per day for 15 days to execute project for PQR. Warranty was provided to PQR for 2 years. Cost of warranty is 1% of direct cost. Warranty is not included in cost. Assume 1 USD equal to rupees 64. Calculate. Yes, Jacob, you have to ignore in the earlier question the man hours for Yama, because that is something your gross profit is already provided. Had it not been provided, then you would have considered. Why was transaction price deducted? I didn't get your question, Jacob. Jacob, transaction price was deducted because the point is that you have to see what addition you will have to make vis-a-vis the ALP. Only then you will get to know, okay, what is the addition you are supposed to make to the income. That is why. Clear? Yes, once you solve this question, I will explain again the earlier question also, no problem. No, Kaushiki. Shall we solve together this question? But I'm giving you 2-3 more minutes time just to think about it. See, how is all the costing problems? There also you have, right, the transfer pricing chapter. Similarly, you have it here. You have to just think in that particular manner. As I told you here, there is no legal interpretation. It's pure question. And in practice, the complexity is all the more. Okay, let's solve together. So here first we have to start with the determination of the gross margin. In the previous question, you were at least given this gross margin. So in the previous question, if you see, the gross profit on Yama work was given, which is a comparable company's gross profit margin. So we directly started with the gross profit margin in the earlier question. Here it is not given. So here we will have to first calculate. And that's why, Jacob, in the earlier question, I did not even consider what are the man hours for the Yama. I didn't consider that. Why? Because here directly the gross profit margin was given to me. So therefore, I did not even consider that. Are we clear? So here we will have to calculate the gross profit margin. For first calculating the gross margin. So calculation of gross margin. Okay. On comparable uncontrolled transaction, that is of PQR. What is my direct cost for PQR? Here the cost is given. Direct and indirect cost are same, which is 100 per hour. So 100 hour USD into how many hours? 100 per hour into how many hours? Anant works for 9 hours per day for 15 days to execute for AB and 8 hours per day for 15 days to execute project for PQR. So 8 hours into 15. This is in USD I am calculating 12,000. Similarly, my indirect cost is 200 USD into 8 hours into 15. This will give me 24,000. So 36,000 is my cost. Right? How much I am billing to PQR per month? I am billing 70,000. I am billing 70,000. So my sales is 70,000. So my gross profit is 34,000. And GP on cost is 34 divided by 36 into 100, 94.44%. Are we clear? 94.44% is my gross profit margin. But this gross profit margin, I directly cannot consider it. I need to make the adjustment. So I will not take 94.44% directly, because here there are certain adjustments. One adjustment is warranty was provided to PQR for 2 years. Cost of warranty is 1% of direct cost. Warranty is not included in the cost. So in the direct or indirect cost, I will also have to consider, or before calculating the profit, let me do it like this. Okay, 1 second. Let me do it like this. This is my actual gross profit. Now, gross profit after adjustments. Right? So this 34,000 which I have, what I will have to do is less, I will have to consider the cost of warranty. I will reduce the profit here. What is my warranty? 1% of direct cost, which is 12,000 into 1%. Now, many of the students will raise the question, ma'am, why less? Why not add? How much is the profit coming to? 33,880. And what will be my gross profit percentage then on cost? Gross profit on cost, 33,880 divided by, don't make the mistake of taking your 36,000. If I am reducing from the gross profit, I also have to reconsider the base. My cost is also increasing because of cost of warranty. Cost of warranty is not included in the cost. So I will consider here 36,120 after considering the warranty charges into 100, which will be 93.80. So I will not only make adjustment in gross profit, but even the denominator. If I'm making adjustment in numerator, I have to make it in denominator, because here the cost of warranty was not considered in the cost. You will say then, ma'am, why you did not make it in the earlier question? Because there it was already considered in the cost of sales. Now your second question to be answered. Why here, ma'am, you are reducing the cost of warranty? In the earlier question, you had added the cost of warranty. Sorry, there was no warranty in the earlier question. Sorry. There was the cost of credit. So here I have reduced the cost of warranty, which is fine. Okay. Now this is my gross profit margin, 93.80%. Now what I will do is I will calculate my ALP. So first, my direct cost, 100 into how many hours for ABINC? 9 hours and 15 days. 13,500 USD. Indirect cost, 200 into 9 into 15, 27,000. 40,500 is my cost. Add here. If you see, here a loan was given. ABINC has provided the loan to Anant towards purchase of software for executing its project. ROI is 3% per annum. Now I will also add this cost. I am not making the adjustment in comparison to the PQR limited. Why? Because here loan has not been given for PQR. Here this is a transaction between AB and Anand. There is no question of making the adjustment on that. This is not a comparable transaction at all. So I will not make adjustment in the gross profit of PQR. Here I will directly consider over here the cost as provided the loan at 3% per annum. So here add loan, interest on loan. I'm assuming this is also at ALP because there is no mention of comparable transaction of the loan in the question. So I'm assuming this is on ALP. So 1 lakh into 3% divided by 12. Fine. So this is how much I'm calculating for a month. So 250 USD. So my total cost is 40,750. On this, I will apply my GP, which is at the rate of 93.80%, 38,224. Right? And my arm's length pricing will come to 78,974. What is my transaction price? What is my transaction actual billing? How much I have done? 85,000. This is 85,000. So actual billing is 85,000. So here I will make the TP addition. I'll make the TP addition of the differential amount. Are we clear? Yes or no? This question is clear. This was pretty simple. Yes, Checo, warranty still to be reduced if it is not considered in the, because this is something which I'm making the adjustment, which is not given to PQR but given to the AB. So we will have to reduce. Clear? If it is already considered in the cost, then you will add it back. Okay? Fine. Now, last time I'm repeating the last question for those who did not understand. Here in the last question, we started with the markup of Yama, 60%, which was available. Since technical know-how was not given to Yama, we reduced that as a cost from the gross profit. Similarly, quantity discount was reduced. Now, there was a question of why do we add the cost of credit? Understand one thing. Beta had offered 90-day credit to Nano. Is it the cost of Beta? When credit is given to Nano, Nano has to pay the interest. Nano has to pay the higher price. Is it the cost of Beta or is it the cost of Nano? The credit which is given, the interest of 90 days is the cost of whom? Is it the cost of Nano or is it the cost of Beta? Yes. Is it the cost of Beta or is it the cost of Nano? It is the cost of Nano, Kaushiki. It's not the cost of Beta. I am purchasing the goods on credit. You purchase the goods through credit card. How is the cost of the company? It is the cost of me if I am purchasing the goods on credit because I will have to pay the higher price. Isn't it? I will have to pay the higher price in that particular case. So it is not the cost of Beta. It is the cost of Nano. Yes, Checo. So therefore, I will not reduce that from the GP. Why I will reduce it from GP? Because I am calculating the GP for Beta over here. Why I will reduce it from GP? I will add the cost of credit. This is the cost of credit of Nano. So I will add it here. Instead of reducing here, I would have reduced if it would have been my cost. My GP should have gone down. Here, this is the cost of credit of Nano. So I'm adding it to the GP. Why? Because the price of my price will become higher because of that. My price in fact will reflect a higher price. If I have given the goods on credit, I will charge the higher price. So that's why I will add to GP. Is this clear now? Well enough. Now did you understand why I have added the cost of credit? Yes or no? Because my sales figure would be higher then. Yes, Jacob, are you clear? So here we will not reduce it from the cost. Here we are going to add it to the cost. Yes or no? Fast. Yes. Okay. So that is how we arrived at this particular arm's length gross profit markup, and that we applied on the cost. Clear? Yes, Kaushiki, you have one question. We have not done adjustment for removing the warranty. Yes, we have not done the adjustment for the removing the warranty. Here, warranty is provided to PQR. Warranty is provided to PQR, and it is not provided to ABINC. So if you see here, what I have done is from the gross profit, I have reduced the warranty. The cost of the warranty I have reduced from this particular gross profit, 34,000. It was not included. So if I would have not done the adjustment, I would have not included itself. I've done the adjustment. I've reduced it from the gross profit. Clear? This is provided to PQR and this is not provided to warranty is not provided to this ABINC. Okay. So we have done the adjustment over here because gross profit is after adjustment only. So you are making the adjustment after the cost of warranty to the profit margin. Are we clear? So if I provide a similar kind of warranty, here I am providing the warranty. So therefore I am reducing it. Clear? Yes. Any questions? Any doubt? Clear? Yes, AB is not sorry. This particular company, Anant, is not providing to any warranty to AB. It is providing warranty to PQR. Now it is providing the warranty to PQR, so therefore we are reducing the cost of the warranty. Because if my gross profit which is there, in case if you see here, the gross profit if I consider 94.44, then this will not reflect the functional difference which is existing. There's a difference in the transaction. I am providing the warranty to PQR. So that is something I'm reducing it from the gross profit, and since it is not included in the cost, I'm reducing from there also. Are we clear? So I'm in fact reducing from the gross profit because I want to make it comparable to that of AB. Clear, Kaushiki? Yes. See, what I'm doing is, in this particular case, if you see the warranty which is provided to only PQR, it is not provided to ABC, Kaushiki. Now, if it is provided to ABC, then we would have not included it. But here it is only provided to PQR. It is not provided to ABC. So the cost of warranty is 1% of the direct cost. That I have to exclude it from my gross profit. Is it clear? Any other question? Yes. Is it clear, Kaushiki, now? Yes or no? Is it clear? Yes, please let me know if it is clear or not. Fine. Okay. Now see, next particular method which is there is on the transaction net margin. Only thing is that here we are going to take the net profit instead of the gross profit. Net profit means the net operating profit we are going to consider. Everything else remains the same. But here, one more thing we need to consider here is that in the case of the this transaction net margin method, what will be my denominator? What is the denominator which I have to consider? That is something which we need to answer. In the cost plus, you are taking the denominator as the cost. In the resale price method, you are taking the denominator as sale. In the net margin method, transactional net margin method, here this is something which is considered as TNMM is considered as a residuary method. Where all the other methods fail, we apply this, and practically this is the most used method. I will tell you why. Because see, under the RPM or CPM, you are using what? The gross profit. Now, because of the accounting differences between the different companies, it is very difficult to take gross profit because some may recognize warranty in the gross profit in the trading account, some may recognize it in the P&L. There are certain expenses which some may recognize in the gross this trading account, some may recognize in P&L. So the data of the gross profit is not readily available in the market. The data of the gross profit is not readily available in the market. And that is why we use the residuary methods, the TNMM method, because the data of the net profit is easily available from the database of the other companies. Also, why we do not use cup method most of the time, because if internal cup is available, it's fine. Most of the time, internal cup is also not available. Also, cup requires a direct comparability between pricing. Sometimes the goods may not be very similar. Sometimes it's not possible to make very precise adjustments because cup requires that precise adjustment to calculate the price. It's not something which is a profit. So therefore, cup also becomes difficult. So therefore, TNMM is the method of last resort. But in TNMM, therefore, if it is a method of last resort, it is applicable to reseller also, it is applicable to service provider also. And that is why the denominator in TNMM is very flexible. You can have the denominator as the cost, you can have the denominator as sales. If you are using it for service provider, you will use the denominator as cost. If you are using the TNMM for the reseller, you will use the denominator as sales. The only thing you should remember is that I should not be using the denominator, which is a controlled transaction. If I'm making the sales to my related party, to my AE, then I will use the denominator as cost. In case I'm purchasing from the associated enterprise, then I will use the denominator as sales. So the denominator also should be uncontrolled. Rest everything remains same under the TNMM method. Everything else remains absolutely same. Are we clear? So on this also, one more question we will solve. Or I'll give you the question and then you solve and we can discuss in the next class. We'll just discuss about the question, which question it is. It is illustration 4 from your module. So Ande Inc. having its business in Malaysia has advanced a loan of 1,60,000 to Ande Limited India. Book value of total assets of Ende was 125 lakh. End Limited provides software backup support to End Inc. End Limited has spent 50,000 man hours during the financial year for the services rendered to End Inc. Cost for End Limited is Malaysian dollar 75 per hour. End Limited has billed at MD 90.75 per man hour. Gamma Limited in India, which is a similar business model, provides software backed support to Olive Inc. in Penang, Malaysia. Gamma Limited's cost and operating profits are as under. Direct, indirect cost, operating profit, calculate the ALP based on the above data. Will you solve now or will you solve at home and We can discuss in the next class. Yes, I'm giving you this as homework then. You will solve now, Jacob? Okay. Please solve now. At least go through the question. In case it will take time, we'll solve in the next class, but start solving it. Thank you, Viraj. Yes, Jacob, I will upload it. Thank you, Viraj. Yes, have you gone through the question? See, first you will have to calculate the operating profit per man hour, which is not given to and INC. You will calculate that, okay? Which is not given in the question here. So first we will calculate that. What is the operating profit by gamma to olive INC? You are given the direct indirect cost. You have given the operating profit. So the operating profit to the cost you will calculate. For the TNMM, we use the term operating profits and not the gross profit. Okay. So that comes to 25%. That comes to 25%, right? And what you will do is you will calculate for the cost of the support services provided by AND Limited to AND INC. So how much are the support services provided? What is the cost? The cost for AND Limited is 75 per man hour. Sorry. 75 per man hour. So 75 into Malaysian dollar is 45. That is, and then you will add to that the 25% as the arm's length operating profit margin. And you will get the arm's length price per man hour. And that you will multiply by the 50,000 man hours, isn't it? And you will compare it with the actual amount bill. Clear? Also, first thing you will have to answer in the question whether these are AE or not. Here, the foreign company has advanced the loan to end whether it is more than 51% of the book value of the total assets. The book value of the total assets is given in the question. No, Kaushiki, that's not the correct answer. Okay, I'll show you the answer. See, total direct indirect cost of Gamma to Olive is 800. The operating profit is 200. Because here it is mentioned clearly what is the operating profit. So percentage is 25%. Now the cost for end is 75 into 45 per Malaysian dollar, which is 3375. On this I will apply 25%. I'll get 4218. 4218 into 50,000 man hours, 21 crore 9,37,500. And what is the transaction price? Transaction price is given here. What is the transaction price? It is 90.75 per man hour. So 90.75 into 50,000. So that will give me into 45. This much. So 67,50,000 is the arm's length price adjustment which we need to make. Is it clear? This is very simple question. Yes, Kaushiki, correct. Book value is yes 125 lakh, Jacob. So both of these are A's. The loan is 1,60,000 and 1,60,000 is in Malaysian dollar, mind it. And the book value of the assets is in rupees. So you will convert first Malaysian dollar into rupees. Clear? Fine? Okay. So I would want you to revise all these questions. We are done with the methods, but not with the arm's length price calculation. Next lecture, it is going to be more intense. So revise this much and come for the next lecture. Okay. Thank you so much. We can stop the session.